Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories in corporate filings, and today we are diving into Trio Petroleum's latest 10Q. Let's just say things are heating up in the world of oil and gas, and Trio Petroleum is certainly feeling the heat, or maybe the cash flow. Before we jump into the numbers, if you love getting these bite-sized analyses of complex financial documents, hit that subscribe button. And hey, join our Discord community for even more real-time insights. Alright, let's look at the balance sheet as of July 31, 2025. One of the most telling signs is their cash position, which jumped to over $584,000 from just under $284,000, from just under 200 and some more money. Oil and gas properties, their main assets, also grew to over $12 million. But here's the catch. Their current liabilities, which are the money they owe within a year, are over $1.5 million. This means their short-term debts are more than their quick assets, which equals a working capital deficit of about $680,000. This is a sign that they might struggle to pay immediate bills if they don't bring in more cash quickly. Main assets also grew to over $12 million. But here's a catch. Their current liabilities, which are the money they owe within a year, are over $1.5 million. This means their short-term debts are more than their quick assets, which equals a working capital deficit of about $680,000. This is a sign that they might struggle to pay immediate bills if they don't. Now let's talk about how they actually made or lost money. For the 3 months ending July 31, 2025, revenue shot up to almost $112,500. Revenue shot up to almost $92,000 from just over $63,000 in the same period last year. That's a huge jump, over 200%. This sounds great, but hold on, their cost of goods sold was almost $98,500 this year compared to zero last year. So while they sold more oil, it cost them a lot more to do it. Their net loss for the quarter was about $1.3 million, which is actually better than last year's loss of over $2 million, which is actually better than last year's loss of over $2.1 million. Looking at the 9-month period, revenues also went up to about $226,000 from around $136,000. But again, their cost of goods sold wasn't zero anymore. It was over $97,000. Their net loss for this 9-month period was a hefty $4.5 million, a big improvement from last year's loss of nearly $8 million. So the company is losing less money, which is positive, but they are still losing a lot of money overall. When we look at the cash flow statement for the 9 months, it really tells a story. They used over $2 million for operating activities. This usually means the day-to-day running of the business is costing more than it brings in. Investing activities also used about $966,000, likely for buying or developing oil properties. The good news is that financing activities brought in over $3.2 million, which means they managed to raise a good chunk of cash by selling stock or taking on debt, helping them stay afloat. This big influx of cash from financing activities, like the $3.4 million from selling shares under their ATM agreement, is what's keeping them going. But it also means they are heavily reliant on outside investment rather than their own operations to fund everything. Trio Petroleum is essentially an oil and gas exploration company, and they really kicked off revenue generating activities in early 2024 with their McCool Ranch field, though they've since discontinued operations there. Now, their main focus seems to be on their Canadian assets in Saskatchewan, which are showing some promise. They're also looking at a project in Utah. They also formed a Canadian subsidiary, Trio Canada, which is pretty standard for companies operating internationally. This Novacore acquisition in Canada for about $650,000 plus company stock is a big step. It seems like they're actively trying to grow their reserve base and production, and Canada is a key area for that. Remember that Asphalt Ridge option agreement? Well, they decided not to exercise the full option, meaning they'll stick with a smaller stake. This suggests they are being very careful with their investment decisions, perhaps a little too cautious given their need for growth. It's also interesting to note that they terminated operations at the McCool Ranch field, a project they acquired from Trio LLC. This move involved writing off over $500,000 in capitalized costs. This highlights the risk in their strategy, where projects can quickly become uneconomical. They use the successful efforts method for accounting for oil and gas properties. In simple terms, this means they only count costs as successful if they lead to actually finding or producing oil. All other exploration costs are just expensed right away. It's a more conservative approach. This next part is crucial. The company itself admits in this report that there are serious doubts about their ability to continue operating normally because they have big losses and not enough cash to cover their immediate needs for the next year. They plan to get more money from investors, but there's no guarantee they'll get it. This is a major red flag for investors. Going back to revenue, all of it currently comes from oil sales, which is pretty focused. They sell to one customer and get paid later. This customer concentration is a risk. If that one customer has issues, Trio Petroleum's income is wiped out. Their oil and gas properties aren't cheap, costing over $12 million. They're still figuring out the depreciation, depletion, and amortization for their new Canadian wells, which is normal at this stage of development. Let's look at their debt. As of July 31, 2025, their total notes payable were surprisingly low, only about $65. This seems almost too good to be true after all the financing activity, but it's likely due to them paying off older debts. However, keep in mind that doesn't include things like convertible notes, which have their own complexities. These June 2024 convertible notes, for example, were a big part of their financing. They raised over $720,000 but had to give warrants for shares and faced potential higher costs if they prepaid or defaulted. It's a complex web of agreements designed to get them cash now. In their equity section, we see a lot of stock being issued. They issued shares for consulting to settle debt and for acquisitions. This constant issuing of stock can dilute the value of existing shares if not managed carefully. They also had a big event in July 2025 where shareholders approved reducing the total number of authorized shares to 160 million. This might be a move to make their share structure look tidier. Looking at what happened after July 31, 2025, they've had some leadership changes. Their vice chairman resigned but is now a consultant. The CEO got a pay raise and a big stock award, and the CFO also received a stock award. Also, they closed another significant convertible notes financing in August for over $1 million, again showing their reliance on external capital. Now let's look at what management says. They are focused on growing their Canadian assets and finding a joint venture partner for their California project. They're also exploring carbon capture and storage, which is a forward-thinking move trying to add value beyond just oil extraction. Remember those revenue jumps we saw? Management attributes the 3-month revenue increase to selling about 4,000 barrels from McCool Ranch last year. They highlight their low lift costs in Canada as a key advantage. And here it is again, the going concern issue. They admit their current revenue isn't enough to cover costs and they desperately need more cash. This is the most critical takeaway for anyone considering investing. They really pushed hard to raise capital this year, bringing in over $3.2 million in financing. Without this, they'd be in serious trouble. They openly admit they might not have enough cash for more than 6 months, and that's a huge risk. They're all about using the successful efforts accounting for oil and gas. This means they are conservative with their asset valuations, only booking costs of successful projects. It's a way to manage expectations and investor perception of risk. As a smaller reporting company, they are excused from disclosing specific market risks, which is common for smaller firms, but still something to watch as they grow. Management confirms their internal controls are effective. This is standard reporting, but given their financial situation, it's good to know the basics are in place. No current legal proceedings, that's a positive sign. No major lawsuits weighing them down. The report points back to their annual report for risks, but the fact that they're still heavily reliant on financing and haven't achieved profitability is the biggest risk. Oil price volatility, regulatory changes, and the need for more capital are all major concerns. They mention unregistered sales of equity securities, but refer to other filings. This means they've issued stock privately, which often comes with fewer disclosures and can sometimes be less favorable for existing shareholders. Finally, the exhibits list shows they filed all the necessary documents with the SEC, including those crucial CEO and CFO certifications. Now, for my take on Trio Petroleum, they are in a very tough spot. The company is aggressively acquiring assets and trying to grow, which is good for potential future returns. Their focus on Canada and their low lift costs there are definite strengths. However, the company is burning through cash and remains heavily dependent on external financing. The repeated mentions of going concern and their need for immediate capital are serious warnings. While they are reducing their net loss, they are far from profitable. The strategy to find a joint venture partner is smart, but success isn't guaranteed. Overall, Trio Petroleum is a high-risk, high-reward situation. They're making moves in a challenging industry, and while they've shown some revenue growth, profitability and sustainable cash flow are still distant goals. Investors need to be comfortable with a lot of uncertainty and the possibility of further dilution or financial distress if they can't secure more funding soon. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.